Good morning, one and all present here. I am Amlan Dasgupta. IMDR currently organizes webinars by various industry experts. Today, amongst us, we have Vaibhav sir as our guest. Vaibhav Vaishnav sir started his career as an associate at JP Morgan. Moving on, he gathered immense knowledge in investment banking sector at Macquarie Capital. He later worked as a research analyst at Bank of America. He also has an experience of working as a research associate at Cowen and Company and also as a senior research analyst at Scotia Howard Wealth. At present, Sir is working as an equity research analyst at Coker and Palmer INC. I feel privileged to get this opportunity to introduce a speaker of his stature who is also an alumnus of IMD. On a final note, sir, we are grateful for your presence amongst us today. Without any further addition, I would request sir to take over from here and share his thoughts with us.
Thank you, Amlan. Thank you, Dr. Shikha Jain. Thank you, Dr. Nagar. Thank you, Professor Randive and Amlan for hosting me. I will be very honest, I'm not one of the very formal types. If you had known my professor when I was in IMDR, you would know, like, I'm not that formal. I'm not very I used to be like a student which used to get in trouble a lot many times. So when they call me sir, I look behind me and say like who are they talking about? But just to introduce myself again, I am Vaibhav Vaishnav. I used to be a student of, my batch was 1997 to 99. I did PGDM. I have done MBA in the US also, but I still say my real MBA was done at IMDR. I own everything, and I mean everything, to IMDR. I own everything to Bhupi, Professor Bhupatkar, Atul Sapre, and Sandeep Apte, who used to be the professor at my time. I'm going to speak with you about equity research, but what I want is, like, my hope is that you guys ask as many questions as you can and make this is as interactive. And like, I know I'm supposed to say that, but actually I do mean it. Like, if you don't ask me questions, I'll go to sleep. It's like 9:30 p.m. at my time. So please do ask questions is what I'm trying to say. So equity research, before I get into what equity research is, I would tell you, like, I used to try a lot into getting into equity research in India. Somehow I could not, and that's why I chose to do my MBA over here and got into investment banking, and then hated every minute of investment banking and got into equity research. Why equity research? We can talk about different aspects. What is equity research? Maybe I can go into that, and then you can ask me anything what you want in equity research. Before that, I would like to tell you a story why I did want to get into equity research. So I was in my second year of PGDM, and Mr. Atul Sapre, I actually just spoke with him like a couple of weeks ago. He was in the US. He asked us to do like a project, and we all got to choose different projects. Some people chose like Indian budget, some people chose whatever, but I chose like do a financial analyst of Kinetic Honda, which used to be a big company at the time. And at the time, this is like 1998, 99. Computers were new. Internet was extremely new. I still remember, like, there was one computer in the library where we had this internet which was still a dial-up, and we had to do like, like how you ring up the phone line and then it will connect to the internet. And anyway, Basically, what I'm trying to say, like when I did my project, I did it all on paper. So you can imagine how pathetic that was. But I loved it so much that I did it for my own project for Kinetic Honda. Then I did it for another person, another friend of mine who was in finance but didn't know really anything about finance. So I tried to help him on the project. And even during when we were looking for jobs, uh, obviously we had a lot of time. I did like a couple of other companies and did my financial analysis, and that's how my love for equity research started. Somehow I could not get into equity research in India. That's fine. I'll come back to that in a minute. But when I came to US, it was for equity research. But then I heard like, oh, investment banking pays a lot more money. So I tried to get into investment banking, but I got my first job in equity, corporate banking, then at JP Morgan, then equity research at RBC. And then eventually I got into investment banking at Macquarie, as Amlan said. I hated every minute in investment banking, but I know some of you guys would still want to go in investment banking. It gives a lot, like it pays a lot. But I hated investment banking and then came back to equity research. And since 2010, so it's almost what 10 or 11 years, I have been doing equity research, mostly for oil and gas. Unfortunately, oil and gas companies are dead now. Nobody cares about oil and gas. It's all about new green energy. So I'm trying to move into new energy. But uh, I studied at JP Morgan. I did a couple of years in RBC, Royal Bank of Canada. I did a couple of years in banking in Macquarie. I hated it. I came back to research, which was at Bank of America. I was there for like about 5 years. And then I went to work for a hedge fund, which is the Illimine Capital. And then it didn't really work out. Life is too short to work for people who are not nice. And then I started Cowan and then Howardville, and now Coker Palmer is my own job, my own business. Coker Palmer is just like a background. They provide me with the CFO and some compliance people, so I take their name, but it's all essentially my own business. So what is equity research? Oh, before I please feel free to raise hand and say like Webs. Well, I call myself Webs over here, not because I'm American or anything. I have been called Webs since I was in 8th grade. When I was in IMDR, I was still called Webs. Uh, but so please feel free to ask any questions on equity research. Um, what is equity research? Essentially, it's fundamental analysis. You can do technical analysis too, and you can do fundamental analysis. But what you essentially do is like, well, you look at a company and say what exactly you do, and look at what kind of business environment you are in, who are your competitors, and essentially what your whole whole project is, or whole emphasis on is on what earnings are you going to drive. You can look at EPS, you can look at EBITDA, and then say, all right, based on my analysis of the company, of the industry, I think your revenues can do 10%, 15% growth, and I'll get back to like why 10%, 15%, and why not 50% or 100%. And based on my analysis of your competitors, you can grow this much, your EBITDA can grow this much, and that's how you're going to do this analysis. Now, I don't know students if you are both in first year and second year, but I want to say they're both first year and second year. But can anybody tell me what is, let's say, take any company that you are looking at, Reliance or whatever. Like I don't know exactly what, I can look up my stock screen and see how much it is trading at. But let's say if if Reliance Info is trading at $100, can anybody tell me why it's trading at $100 and not $1,000 or not $5,000? Second year? No? Nobody? Okay. So I'll go in. I'll go. This is what uh, is it's like if you think about the stock price, right? What is it? It's really a discounted cash flow. You as a company, ABC, Reliance, and for in my example, take any company, you are gonna generate so much of cash in 5 years or 7 years or 10 years, depending on what discounted, how long do you do the DCF for. And then at the terminal year, so at the end of 5 years or seventh year or the 10th year, what your what what are you gonna uh, uh, earn in terms of cash flow, and then I take a terminal value based on either EV/EBITDA multiple or a perpetuity method and say, all right, so for next 10 years, you're gonna let's just say you're gonna generate $10 each. I use dollars. I'm sorry, but because I've been doing this for a long in the US, so I keep using dollars. But take dollars, take rupees, doesn't matter. Take over next 10 years, you're gonna take $10 a year, and at the end of 10th year, let's just say I'm doing a DCF based on 10 years. I think at the end of 10th year for perpetuity, you would grow at 1.5% or 2%, and we'll talk about why that is. And then what's the discount rate? So discount rate would be WACC, right? WACC could be, you could be very analytical and say, what is your beta? You can do levered beta, do unlevered beta. Is it a levered or unlevered beta against what is the base index? Are you using Nifty? Are you using S&P 500? And then think about WACC. And then think about the perpetuity growth, or you can do like simple way is do EV/EBITDA multiple. Well, yes, you can do that, but it kind of defeats the purpose of doing a DCF in the sense, well, I can do EV/EBITDA and say like Reliance Info in my example, I'm gonna assign you 7 times or 8 times EV/EBITDA and get you a stock price, and your stock should be trading at that. Or I can do a DCF and say like, well, perpetuity, you can grow a 1.5%, 2%, and then discounting it back. This is the DCF. So essentially, the stock price is discounted cash flow of all the cash flows that you're gonna generate over next 10 years or into perpetuity. The simpler way of DCF is EV/EBITDA or price earnings multiple. It's nothing else. If I say company ABC has 8 times multiple of EV/EBITDA, what it really means is if I had to do a DCF and I do all calculations for next 15 years, 20 years, and it come down to a price, it will be basically an EV/EBITDA multiple of such and such. And that's what the stock price is. So that's one thing. Like when I was in IMDR, and at least first or second years, I didn't know like, well, what is stock market or how does the price map? And like, believe me, I have many friends who work with me or like who are in industry, not in finance, and they're like, oh, this guy, Amazon or Microsoft or Tesla, or like, oh, it should go up 10% or 20%, or it will go from whatever $100 to $200 without really realizing what they are saying. But that is essentially what equity research is. You are trying to find what is the earnings potential of a company over next 5 years, 10 years, 15 years, and what does that all mean after discounting in terms of today's stock price. That is essentially equity research. That is financial analysis, fundamental analysis, sorry. Technical analysis is you can look at, well, stock charts, and you can look at different candles and everything, and you can say, well, this stock is going to go up or down and all that. I'm fundamental analyst, so obviously I don't like technical analysis, but technical analysis or technical analyst, but I'm pretty sure one who is a technical analyst will say the same thing about a fundamental analyst. Like, well, what do they know? How do they know what they are going to earn in 5 years or 10 years and all that? But to be honest, even if I'm doing fundamental analysis, there is like a lot of, not a lot, but like there's some importance that I give to technical analysis. So if I think about like, okay, I have got 15 stocks, right? Like I have to create a portfolio at the end of the day. Me as a sell side or me as a buy side. Uh, I don't want to go too much ahead, but let me just explain what is a sell side or what is a buy side. Sell side is me, investment bank, or equity research or brokerage firm which advises clients like Fidelity or Tiro or hedge funds or investment funds or insurance funds saying like, hey, you should buy or not buy this stock, or you should short this stock or whatever, right? I have $0 at risk. I'm just advising. So really the stake for me is pretty low. And that is called sell side analyst. Buy side analyst is the people who I'm advising. So the other side of the table, like, all right, mutual funds or hedge funds or investment funds or insurance funds, who I'm telling they buy or sell stocks and they create a portfolio and they have to live with the consequence. So I can say whatever, like buy Microsoft, and Microsoft can go down 50%, I will still keep my job because I'm sell side, buy side will lose its job. So when I as a sell side try to think about any stock, there are multivariate fundamentals that we should look at. Like it's different sectors. So I used to be in oil and gas. As I said, oil and gas is dead now. I'm going more towards energy, green energy. But let's say if I just think about oil and gas, there were like different factors which drive oil and gas stocks versus what drives technology stocks versus what drives medical stocks. There are different factors, and like once you go from sell side to buy side, you realize that there are so many different factors that impact stock price besides fundamental analysis. Just because I think this company is going to earn $100 tomorrow, it's not necessarily that that's what's going to drive everyday stock price. It could drive over a longer period of time, but tomorrow it could drive like, oh, this stock is getting out of this index or that index, and there's technical things which will impact. And that's why even I don't like as much technical analysis. I still prefer in my multivariate function, my multivariate model, where I rank, let's say 15 or 20 stocks, and I have to create a whole portfolio. What, how, like I assign 10%, but it's like completely up to a person. I said like 10% I'm gonna give importance to technical analysis versus fundamental analysis. And I can say fundamental analysis like, oh, the street consensus, like people like me, sell side, there are like 20 of those. We all come up with say like company ABC will earn $2 next year. I can say $2. Somebody else will say $1. Somebody else can say $5. Somebody else can say $3. Everybody has different way of approaching the stock. So then you become like okay, what is the average earnings? And then the stock really works on that average earnings. So I can say like, oh, average earnings for this stock based on 20 analysts is $2. But I myself have so much confidence that instead of $2, it will earn $5. Okay, right. So today's stock price is $10 based on $2 earnings. So that's like 5 multiple. But if I think the multiple is right, but I think my earnings is a better measure, that stock is really worth $5 into 5 times, which is $25. The stock can go from $10 to $25. That's my thought process, my confidence level. I have to put a lot of work into that. But based on that, I like, okay, that's one's earnings. Other is are there any catalysts what will be driving the stock, and then there's like technical analysis, and I combine all that, give different weightage to each of the fundamentals, and give some weightage to my technicals, and then say like, okay, in my 20 stocks portfolio, I'm going to rank based on this rankings, and I'm going to have like a weighted average of each of these fundamental factors that I just mentioned, and who ranks amongst them, and like I'm just gonna pick one top one, two, three, four, whatever number of that number of portfolio I want to like number of stocks I want to have in my portfolio. That essentially is equity research. Now,
Excuse me, sir.
yes, sir.
Amlan here. Sir, actually, there is a hand raise from a question from a student.
Yes,
So, within
please.
can I ask him to ask his question?
Absolutely. Please ask me questions. I was like hoping somebody will ask me question.
Uh, Thank
Hello, sir.
you,
Good
sir.
morning.
Hey.
Digonto, you may unmute yourself and answer the question.
Yes. Sir, I'm Digonto Chakraborty. I am a technical analyst, to be honest. And
No offense. No offense. Sorry.
yes, sir. Sir, I manage my portfolio since my last 4 years, and I have generated a CAGR of around 18% per year. But I just want to ask, since my portfolio, I'm very young at age and my portfolio is less, I just want to ask you that what is the difference in risk management when you deal with larger portfolios in compared to small portfolios? How do you manage the risk?
So like I I would say it comes down to percentage, right? So what I'm trying to say is, so let's say when I was in hedge fund, right? So my team was of 3 people, and we used to run $1 billion, and I was running about 300 to 400 million dollars. It depends on day to day, right? Like I won't have my full positions every day. But let's say, and I would have like based on that 300, $400 million I need to invest, there will be some stocks which is more like, okay, I need to put capital to work. So even if I don't have like very high conviction, I have those stocks are very liquid, so I can get in and get out. But I will not have any position which is more than 7 or 8%, like any position which is more than 7 or 8% of my total portfolio. So okay, so I was, let's just say for argument's sake, I was running a $400 million portfolio, right, at the time. Now, my boss at Bank of America, he started his own hedge fund, and he used to run only like $25 million, but he would have the exact same principle that he cannot have more than 7 or 8% of any stock, which is more than like 78% of the portfolio. So it comes down to more as a percentage game. You and like then in, so that is one. It also depends on what kind of funds you run, right? So the fund we were running, it was not highly concentrated. It depends on what your directives are. Like let's say there are some funds which would be, we will hold very concentrated position. We will only hold 7 or 8 positions, but very concentrated positions. So that is one way of doing it. The way I was, it was more of a market neutral portfolio. So we could not be like ultra long or ultra short any like net on a net basis. So we
Okay.
would kind of imagine like we could be long or short that way. So it comes down to what kind of portfolio you are running, and then we can get into, okay, what is volatility, what is other kind of what are other kind of ratios. So it comes down to what kind of mandate you have. But
Oh,
just because you're running a big portfolio versus a small portfolio, like even like my boss, who was my client, so he was my boss, then I became his client, then he became my client, everything goes around. But he would be like, he and I are still very good friends, and like yes, like he would have almost the same number of positions in his portfolio, even if he was running like 25 million, as opposed to I was running 400 million.
okay.
Does that make sense?
Yes, sir. Yes,
Yeah.
sir. Sir, I have another question.
Mm-hmm.
That how do you see this new trend of algo trading and quant trading?
Oh, I hate it so much. Uh, well, so think about it, right? Like, I hate it doesn't mean it's going away. It has increased. we can argue both ways, like whether it should be there, whether it should not be there. Um, if you think about, again, I'm biased, right? Like we all have our biases. I'm a fundamental analyst, so I think I'm so much better. And sell-side analysts have too big big an ego, anyways, to begin with. So take it with a pinch of salt. But think about it. GameStop. Let's just say GameStop. It's an example, a perfect example right now. Not
Yes, sir.
exactly 100% applicable, but let's just say GameStop. GameStop was like under $15 in October and November.
Yes, sir.
It's I don't cover GameStop, but like few people I've spoken with, like that was going about to go bankrupt because of Robinhood and all other example. It went from $15 to $450, and now it's back to like $50.
Yes.
That's a different phenomenon, but think about that. Like what's driving that is okay, some Robinhood investors, but it's almost very similar to analogous to um, algo trading. It's like algo trading have very few, like, all right, if the earnings are going up, like you can define what the parameters are, right? Like why do you want to buy in or get out of some stock, and you are doing uh, high frequency trading, right? You are not looking at like, oh, if this company is going bankrupt or not. If just think about GameStop, like if GameStop was to report on earnings, which basically would say, oh, my third quarter or my fourth quarter street consensus estimate, that average estimates we talked about, it's going up, and if the algo had like, well, if the estimates are going up, we should buy the stock despite whatever, if GameStop is going bankrupt. That's, if I'm a fundamental analyst, I'm short that stock, right? Like I'm not going to buy that, or if I'm a hedge fund, I'm going to short that stock. But algos will go completely against me and make me suffer losses, which is fine. That's fine. That's part of the game. But that's more, you define certain parameters which are not definitely, like, which you think are fundamental, which are mostly many times are fundamental, because earnings estimates going up is a fundamental reason to own a stock, but it doesn't look at beyond one quarter, beyond two quarters, or beyond the parameters that are there. So that's why I don't like stock. I don't like algos. But let's be very honest, right? So I was at Element Capital. Element Capital is just one of the pods. So like, oh, I don't know if you guys think like a billion is a lot of money, but let's be honest, Millennium umbrella hedge fund has, I don't know, hundreds of such pods, such people running $1 billion. And they have this 100 pods, let's just say, I don't remember exact numbers, but let's just say 100 pods. Pod is like a team of 3 or 4 people running a billion. 100 pods running this fundamental analysis. So they have 100 billion on a leverage basis running this 100 billion. But they have exactly same number or much bigger number in algo. And they are just trying to play the algos against fundamental analysis, because as a Millennium, that's their portfolio. Some have algos running, some have fundamental analysis, and as well as a Millennium pod or Millennium as a umbrella fund, they are just like, that's their portfolio construction. Having said all that, algos have increased in terms of how much they trade versus fundamentals. There are days where I will like, why the heck is stock going up or down? And unfortunately, the answer comes to, oh, algos are doing this or algos are doing that. You can argue in favor of algos. Well, fundamental analysts have done not such a great job. So that's why should we pay people to do fundamental analysis and build a portfolio when algos can do as good a job?
Okay, sir.
I think there are more people who want to ask questions.
Okay,
Yes,
sir.
sir.
Thank you.
Sir, thank you, Digonto, for your question. Classroom number 19. I see there's a question from classroom number 19.
Can I
Could you
ask
unmute
one?
and ask the question to sir?
Can I ask one
Yes,
question
sir. Yes, sir.
just for my
Yes, sir.
nostalgia? So class 19 is what? Is it the PGDM1 class? Just if I look at all the classes,
Yes,
which
sir.
Hello, sir. Rishikesh here. Can
So
I
it's
ask?
all easy
Sorry, go ahead.
Can I ask a question, Amla?
Yes, I'm like, sorry, go ahead, I'm not.
Okay, sir. Firstly, I'm Rishikesh Karandigar. Firstly, I want to tell you in lockdown, I was a day trader, or you can say a short-term investor. But because of some missed opportunities, it made me an investor. So what would you suggest to have a investor that he should have more amount of companies with a less in his portfolio with a less quantity, or more quantity but to invest in limited number of companies?
I'm sorry, I didn't catch your name.
Rishikesh.
Rishikesh. Hey, Rishikesh. Oh, so I'm very blunt. I'm very straightforward. Uh, if you ask my parents, what do I do? They will say I am gambling. Uh, I have done this for 15 years. I have tried to explain them, I don't know how many times. They still think I'm gambling. There's a difference, right? Like, I do a lot of work and try to think about what stocks to own or what stocks not to own. And I'm still wrong 45 to 50% of the times. So I don't like day trading. Like, I have friends who do day trading, but I cannot do day trading. I will also tell you, like, well, I have people who manage my money. So, like, my personal account, I don't manage my own money. I let people manage my money. The reason is I am like too much of, like, I need to learn this and I need to learn that and I need to learn this about the company or the stock before I can buy or sell. And obviously I have to do my own job, so I can do that both. Uh, Having said all that, so please take it with a pinch of salt. Like, well, day trading, like, I really don't know how I can day trade. When I buy a stock or I short a stock, even if I'm in hedge fund, which is like, oh, hedge fund are like, oh, they go in a stock or go out of stock in within a month. I used to go in a stock for like a 12 months or 18 months, and I used to short a stock for 12 months. Um, so I don't know how exactly I want to tell you in terms of day trading, because I've never done it. What I would say is, well, there will be days, right? There will be days you will make money because the market is with you, and there will be days where well, okay, yeah, it's against us. What's the conviction level? What is the process? Like, two things I would like highly recommend for anybody who wants to do an equity research, and this could be completely different in India. So you have to take, like, well, in US it could work. Like, nobody, if you speak with any portfolio manager, if you speak with any analyst, nobody will speak about the stocks. They will all talk about their process. I like this stock or I don't like this stock. Great, that's the answer. But how do I reach to that conclusion? I may have completely different approach versus you. Doesn't mean I'm right. Does not mean I'm right. Like, I know people who are like so much in the weeds about the stock, and then they come up with one conclusion. And there are other clients I have who take top-down approach, and they make the same amount of money. So it comes down to your personality, how you go about it. So, and now to answer your question, should you have more or should you have less? Well, if I go back to my original thing, like, well, I don't want to have more than 8 or 9% of my portfolio in any stock, with even where I have done enough work and where I have the most conviction, because eventually that will blow me up. Blow me up means, well, I lose a lot of money and my fund has to close down. You should have positions across like different spectrum based on your conviction level. So let's say if you are doing $100, 100 rupees, please pardon me I keep using dollars, but please pardon me for that. So let's say if I'm doing 100 rupees of portfolio and I don't want to have $8 rupees of portfolio, and in my biggest position, my smallest position could be like $1 or $2, right? So there could be at $8 there will be like 12 stocks, but I can't have I would be better than Warren Buffett if I had so much conviction in 12 stocks. I would have some with $8, 8 rupees, and some will be like 1 rupee, so there will be like 15 to 20 stocks. But you have to diversify unless you have done enough work. Like there's one saying is market can remain insane for longer than your fund can remain liquid or viable. I may think GameStop is a bankrupt company, but if it goes from $18 to $450 in 2 weeks, and if that is my biggest position, my fund will shut down. I'm sorry, I don't know if that answers your question.
Abhishek, is there a question from you?
Yes, I have a question.
Yes,
Abhishek,
please go ahead, Abhishek.
my name is Abhishek Bruse. I'm from President One. So you talk about the hedge market. Okay. So what is the difference between a mutual fund and hedge fund? So can you please tell me?
Sure. Good question. Very good question. So we talked about sell side and buy side, right? Like sell side investment bank, I have nothing at stake. It's more like मैं ज्ञानचंद बन रहा हूँ and I'm giving you advice, and you lose or gain money. I don't care, right? That's sell side. And buy side is like, well, I have to leave my consequences. Now on the buy side, there are two kinds of funds. One are called long onlys and one are called hedge funds. So long onlys, what they will do is they only can buy a stock. So let's say if I like Reliance or if I like Tata or whatever, I will buy that stock. But let's say if I'm a hedge fund, it's called a long short portfolio. So what I can do is I have $100, right? And I can put $50 on long positions, $50 on short positions. So think about, I can make double money. So think about, let's say, I'm just going to take Reliance and Tata, for example. And let's say Reliance and Tata are at $50 today. And I like Reliance, so I go long, means I buy that, and I don't like Tata, so I short that stock. And this Reliance goes from $50 to $75, and this Tata goes from $50 to $25. So if I'm buying one share of each or shorting one share of each, I'm investing $100 and I'm making $50 because I got $25 on being long this stock and $25 being short this stock. That's how long and short play. I'm long something, but because depending on what mandate you have, normally they are like beta neutral. So I have to be long and short like equal amount of position on a beta adjusted basis. If I'm a mutual fund, I can only buy long. So I can only go and buy Reliance. I cannot short Tata. So mutual funds, and like another difference is typical hedge funds, as I said, like go in or out of stock like a month, 2 months, 3 months. When mutual fund buys, they buy for like a year, 2 years, 3 years. So like a Reliance CEO will like to speak with this long only because if he knows like, well, if this guy buys, he will buy for 3 or 4 years, as opposed to hedge funds, like, oh, he can get in and get out of my stock in 1 month or 2 months.
So what is that? Nowadays, electronic vehicles are increasing, sales are increasing, and also companies are investing heavily into research and development of electrical vehicles. And one of the report has said that towards 2013, there will be 50% of the electronic vehicles on the road. And also the petroleum minister of Kuwait has said that people are adopting go green lifestyle. And also he has said that digging digging deep into the oil reservoir getting costly. So the drilling cost is getting costly. So the petroleum cost will be rising. So what is the future of profitability of the oil company?
Okay, so Rohan, I want to make sure I heard your question correct. So what you're saying is electrical vehicles are gonna go up, and because of all the green, like all the environmental issues and government policies, and what impact would it have on oil and gas profitability? Is that fair?
Yes, sir.
Okay.
Particularly petroleum companies.
Okay. So I wish I had a different answer, but as I said, like I have been doing oil and gas research for the last 15 years, and I used to cover, like when I was at Harvardville, I used to cover 30 stocks. At Coker Palmer, I initiated, so I started only on like 8 stocks, because out of the 30 stocks, only 8 stocks matter. Everybody else like has moved on. Um, I'm not going to say oil and gas goes to zero, right? Like, because if you think about the broader environment, oil and gas right now still contributes, call it 90% of energy. May that be in electricity, may that be in vehicles, may that be in aviation, call it what you want to call. But as we move forward, obviously the Paris Climate Agreement, like the US will hopefully rejoin Paris. Oh, actually, they have already said they will join. EVs, electrical vehicles, will become more important. Does that mean oil and gas goes to zero? No. So like if you think about this, and I will be very honest, I'm like I tell even my clients, I'm 3 weeks old into energy transition, which is electrical vehicle, hydrogen, back. They will still be very, very relevant. The problem will become is if you just think about oil and gas companies, is everything is driven by the price of oil or the price of natural gas, right? It's like, well, okay, they produce so much units of oil, so much produce units of gas, and multiplied by number of, like multiplied the price per unit, you get the revenue. The problem will be now the price could be very much in the range. Just to give you like very broad numbers, the whole globally, we as in the whole world use about 85 million barrels a day of oil. Aviation, electricity, vehicles, everything together, 85 million barrels. The biggest like International Energy Association, IEA, is like the well-known authority on like trying to find oil and gas supply and demand, or like do the statistics around that. If I were to believe them, they themselves would say by 2030, the oil used in aviation or this cars or trucks or everything would, like EVs, electrical vehicles, will replace or displace oil by 4.5 million barrels. So like almost 5%. Now 5% doesn't sound that big, but oil prices move on couple of 100,000 barrels a day swing. So it might, if someone, like just think about this, right? I don't know if you're reading about Texas, but there's a winter storm going on right now, because of which Texas, which is the biggest producing region in oil for in the US, has like 3 million barrels are offline, and the price has gone from like $55 to $60 only for 2 or 3 days, right? But if you think like, well, such a small amount of oil barrels can, like $5 swing is a big swing. It goes from $55 to $60. That's like almost a 10% swing. That's a big swing. So like if you think about by 2030, 4.5 million barrel goes away, or like the use will go away. That will be a problem for the oil price. So what it will happen is, yeah, as I said, like very similar, like 30 companies which I used to cover, they were meaningful. They used to be over $1 billion, $2 billion market cap. Now they are under $1 billion, right? The number of companies which are meaningful will become less. There'll be some zombies left. There'll be some profitability, but it comes down to now like, okay, I cannot, like if I think about DCF, discounted cash flow, where I talk about, and where I say like, oh, the revenues will grow at 1% or 2% for perpetuity. Well, that is being called into question because my oil production is going down or oil consumption is going down. So my price, the stock price will have to suffer. Companies who have good balance sheet, only those will remain.
Okay, please go ahead.
Good morning, sir.
Hey.
So I'm Priyanka, and my question for you was, could you give any advice for undergrads who want to get into equity research or finance as the main domain? Yeah.
Advice. Well, so yes, I mean, like it's very simple, right? Like if you have figured out that you want to do equity research, that's actually pretty awesome. Very few people, like even in my batch, very few people knew exactly what they wanted when they got out. We just like, okay, this company is coming to campus, we'll sit for this interview. We'll come. This company came and we sat for that interview. I was lucky. I was not selected in any interview. So I was lucky or not lucky. That's a different question. But or I was not smart enough. But if you figured out that you want to do equity research, that's the first like major step. Uh, just like it has, if you like equity research, it has to move like numbers talk to me. Like when I do my model, and I'm like obviously at my age or at my level, I can ask my juniors to do my like go build this model and we'll figure out what the earnings are. I don't do that. When I put in the financials, okay, this is the revenue, this is the COGS, this is the operating expense, this is balance sheet and all that. Those numbers actually speak with me, and I can figure, I can like relate to like, okay, this company can do this or they cannot do this. So just work on those numbers, like have very simple model, and then work on those models to like have like if you do one or two or three companies, you will understand like how a model works, and then you will figure out like, okay, be below the operating expense. So like if you think about EBIT, anything below EBIT is very easy to model. Is the biggest challenge is how to think about revenues and then how to think about COGS, and just work on like two or three models and you will understand like, oh, this is not that difficult. So that's what I would like right now, like in today's world. Obviously you have computer, like when we were there was like one laptop which we had to borrow for some companies presenting at IMDR campus. So like nowadays everybody has laptop and everybody has everything, so it becomes easier for you. But that's what I would like, do a couple of models, take any company, I don't care, and try to think about like, you may get a wrong answer, but it doesn't really matter. It's like how you think about those revenues and how you think about that cost.
And one more question, like
Mhm.
in your view, how safe is ER for the rapid automation right now?
Rapid automation. Sorry.
Like everything is getting automated. So how, what are your views on that for
Uh,
equity?
you mean like, is your question is equity research gonna be done with the automated risk? Like, sorry, I don't understand your question.
Right, right. That's the question.
Can you repeat? Like, can you explain? Like, can you tell me what exactly you're asking? Like, I don't get your question. Sorry.
Like how safe is a job of a equity research analyst? Like
Oh, okay, got it. See, like, if you think about machine learning, artificial intelligence, and believe me, like, obviously, I'm an Indian, so I have many Indian software people who are my friends and who keep asking me, oh, can't you automate this or can't you automate that? And it can be. Uh, algo trading is an example. But the problem with that is you need a lot of data points. If you think about artificial intelligence, or you think about machine learning, or you think about all this automated, you need a lot of data points, right? The problem with fundamental analysis, why it cannot be doing the automated, or at least that's what I like to believe because I still want to earn money, is um, you don't have as many data points for machine learning or artificial intelligence, because the revenues could move up or down so wildly sometimes, because given different factors. So like one quarter can be impacted because of this, and one quarter can be impacted because this. I'm sure there are a bunch of very smart people who can put all those data points and various factors and try to think about that model and put it into this, put into like, okay, what it will generate. But think about that, like, oh, they can generate it for next quarter, but does the stock really uh, trade only on next quarter? Well, it can trade on next quarter plus one, or it can trade on next 12 months, or it can trade on next 24 months. So on a fundamental analysis, there would be lesser of risk. I don't want to say like I'm biased against technical analysis, but so I don't want to go there. But maybe there are different factors that you can do it on a technical analysis. But from a fundamental analysis, the biggest problem is you don't have that many data sets to automate it.
Good morning, sir.
Hey.
First of all, thank you so much for the wonderful information which you are providing. I have a question. Am I audible? Am I audible, sir?
Yes, Prasad, you're audible, but I would suggest you keep your mic a bit closer.
Okay. Uh, I have a question. So, can you tell us in simple words what is derivative and how to trade in derivatives?
Oh boy. Oh, you're asking a wrong person about derivatives. Oh, you're asking such a wrong person about derivatives. Like, if are you like derivatives can be defined in different ways, right? Like, are you talking just options, put, call? Are you talking about futures? Are you talking what, right? Or there could be financial derivatives. Uh, I mean, like, I would be very honest. I'm not good at derivatives. Well, I'm not good at anything, but I'm especially not good at derivatives. But here's what I would say. So let's go back to my oil and gas, right? And like I have different screens. So let's say crude oil, right? Crude oil next month. So this is February. So like anything that closes in March, the contracts for futures for crude oil that closes in March are trading at $60.03. But 12 months out, futures are trading at $55.26. Okay, so what does that really mean? Well, it comes down to time value of money, and it comes down to volatility and Black-Scholes model, and I'm not going to go into all that. But essentially, the way I think about derivatives, and I'm mostly talking about calls and puts, is what and it comes back to again the fundamental analysis. Like, I can go and buy a stock, like I can go and buy Reliance for $50 today because I think it will go to $80. Or I can say, well, I will buy option to buy that stock. Options could be like an option. It has to be like like liquidity is a big thing. Like, well, I may want to buy options, but there's nobody else who is the counterparty. I can't do anything about it. So assuming there's enough liquidity, I can say, well, I would like to buy options to options dated something, let's say 2 months. My thinking is it goes from $50 to $80 in 2 months. I would say I want to buy options to buy Reliance at $80 with contracts ending, let's say April. And what I'm gonna willing to pay is maybe some margin. So let's say $1 or $2, right? So what I do is I have logged in saying like if I'm right, think about it, right? If I'm right, what I'm really gonna do at the end of that is I'm telling you today I will buy the stock from you and I'm gonna pay you like $1, $2 margin. But 2 months from now it's like $80. So I'm actually just gonna like profit in, like I'm paying $2, let's say $2 margins, and the stock actually goes to $80. I'm making a margin on $28. And now think about, everything comes down to returns. I should have spoken about returns, but everything comes down to returns, right? So think about it. I'm just putting $2 of capital and I'm earning $28 of in returns. That's huge returns. Everything is return on investment. So like that's all what it is. It's like I'm just trying to do like a time value saying, but only in this case it's time value plus volatility plus few other things, and say, well, if I think the stock value or futures value in terms of like crude oil, as I said, like 55 and 60, like some that value would be different from what it is today. And instead of buying it, like I'm not taking the whole title to the stock. I'm just paying you a margin to get like for a promise to buy or sell that stock. So like in my example, when I say like, oh, next month crude is $60 and 12 months from now it's $55, like how does that happen? Like that doesn't make any sense. In theory, the price should be always going up. Well, because that's demand supply, and right now it is winter storm, so you don't have enough oil today. That's why I'm willing to pay you more versus 12 months from now when I think like that's more fundamental and I don't want to pay $60. I'm so sorry, like I'm not the best guy to talk about derivatives. Dr. Nagar will like laugh at me if I say anything more on derivatives.
Sir, I had one more question. What will what would be your advice to be a long-term investor, or to take some good risk and be a good trader?
Well, investors and traders are different things. Like I have a trader who trades stock, and they will tell me the way they speak, oh, this thing is going to 50 and this thing is going to 40 or this thing is going to 80. Like, oh, okay, thanks for telling me. That's trading. An investor is like, all right, I do fundamental analysis and say this company can earn this much, and I want to pay so much multiple based on 10 years or 20 years of history or based on comp and all that, or I do a DCF, and that's investor. So traders can take position. They can, like, obviously, I'm not saying traders don't make money. Traders make tons of money, and like they are very successful also. But trading is not investing. Trading is like, or I want to get in and get out of stock in a day or 2 days, and fine. That's different than versus doing the hard work and talking about fundamental analysis.
Hello, sir.
Hey.
I rely on both fundamental and technical analysis, but almost every time me and my father fight or debate on this point. Like you, he is a fundamental analysis, and he always tells us to rely on only fundamental analysis. Yes, he said that you should have knowledge about technical analysis and chart, but you should not rely on that every time. So what is that one thing every pure fundamental analysis hate or not like the charts and technical analysis?
See, technical analysis is more of trend analysis, right? Like think about candles, think about shoulders, think about double shoulders, think about double dips and all that. And I'm like, again, like I put 10% weightage to that because there are like, if you look at the real time stocks, how they trade, and think about 20 days moving average or 50 days moving average or 100 days moving average, they would like, oh, the stock could, let's say, again, I'm going to give some example. So stock ABC, I think it's going from $50 to $80. But if I think about, let's say, okay, the stock is going up, hopefully, I'm right. But 50-day average is coming from up to down. So they will be like, oh, when it touches 50 days, there's like a day or 2 day where it needs to consolidate. And then it can move up. And then you can have 100 days similarly up or down. Or like 100 days can move up from bottom to like where the stock is. And then it can break out. So there could be like, oh, from 50 to 60, it is consolidating, then it breaks out to 80. Like it helps. It could happen, it may not happen. And that's the problem, like with like, oh, I need to respect that, oh, if it's a 50 days moving average or if it's 100 days moving average, am I going to change my position based on that? No. If it's, but I can understand like why the stock is doing this or why can stock doing that. And then think about like, oh, it goes to 60, but I'm have conviction and it has to go 80, but because of technical, it goes down to from 60 to 55. I can increase my position. I don't have to be like I was buying. I bought 5 million worth of stock at 50, and now it has gone to 55. Okay, and I can go down from 55 to 50, and I still have the same conviction. I can go from 5 million to 10 million, and now I'm going to make more money on that investment because now I think like okay, that 55 to 50, and it's going back to 60, but I invested more. So like it helps. You should respect technical analysis. Uh, I just don't want to use 100% of that, is what I'm saying.
Thank you, sir.
Mm-hmm.
Thank you.
Thank you, Rishikesh. Anyone else from classroom number 19?
Hey,
Uh, yes, Abdul, please go ahead.
I can't hear you really. Go ahead, I'll try.
Actually, the equity research is more inclined towards the finance. You talked about the finance and the fundamentals. So my question is like being an engineer, how can the non-commercial background students look forward to this field as a career, and what kind of things we should do to make it more interesting so we can enter into it?
So your question is, let's say, if you're not from finance background and you want to do equity research, how does it help? Or how should you do about it? How should you go about it? Oh, actually, I would say like there's nothing that's written that wow you should have finance background. I'm like you need to understand the financial statements and everything, but think about it like well okay you know accounting. I can send you a model, right? I can send you my model and you can have income statement, balance sheet, cash flow, and everything. But remember the thing I said, the most amount of time you spend is on how you think about revenue generation and how you think about cost of goods sold. Let's say you are an engineer and you become an equity research analyst, and let's say you are an automotive industry engineer, you will have so much more knowledge about how the automotive industry works versus me, right? So I can think, oh, this guy, like I just keep saying Tata because I'm ignorant and I only know Tata. It's fine. But Tata makes 5 cars or Tata can make 10 cars versus, I don't know if Ford or GM is there, but let's say Mahindra can make 20 cars. You will know, well, oh, I can say Vaibhav says GM, not GM, Mahindra will make 20 cars, but or sell 20 cars, but Tata will sell 50 cars. But if you are an automotive engineer, you may actually know well that is not the case because or whatever. Like this two companies are competing in Delhi or competing in Chandigarh or wherever, and over there the terrain is like this. That's why Mahindra car is not that good or Tata car is not that good. So you can bring all that perspective into revenues and like, oh, well, Weber thinks 20 cars versus 10 cars, it can be actually 5 cars versus 10 cars or something like that. So there are many, like if you think about biotech, like think about biotech, right? Like, well, what will a guy like me do anything in biotech. I have no idea if this biotechnology will work or not. There'll be like some PhD, some doctor who actually will, like somebody who will know if this technology will work or not. So it can come down to, oh, you just need your financial analysis, how this three financial statement works and everything, which is pretty simple. But then you can bring in your perspective from your whatever your vertical is.
Okay, so arriving to this, actually want to ask that, can you suggest courses or anything to do to start in this type of field? Any type of certification that will very, very
Sure. Uh, so CFA. So like obviously Dr. Nagar is teaching you finance, so that helps in like the fundamental understanding of like the finance, right? But for equity research, I would say, like I tell students over here also who want to do equity research, is you don't need to do an MBA. That's for here. Over there, it's different. So you have to understand the perspective. But CFA is more important because it will go through each and every aspect of equity research, equity valuation, debt valuation, and everything in much more detail. So if an undergrad comes to me and say, oh, I want to be an equity research analyst in buy side or sell side, I would say, well, do CFA. If he or she only has to do one of the other things, do CFA. What MBA gives you is a basic framework to think about the business. CFA will not give you that. Like when I think about a company and all the aspect on all the strategy, MBA gives you that, especially IMDR. I'm sorry, I'm very biased towards IMDR, so uh, that is more important. Like that is important for like your general, general knowledge or general understanding of the business.
Abhishek, you can go ahead with your question.
Hey,
yes, I have a question for you, sir. So what is your opinion about cryptocurrency and in sense of that, how the Bitcoin works, on what dynamics that Bitcoin works?
so let me ask you this. Um, Cryptocurrency goes 50,000 today. Was 15,000 2 3 months ago. Was 35,000, 35,000, 30,000, 15,000, 50,000. Do you think any stock works like that? It has to come. It has. You have to be able to value it.
Yes, sir.
If it fluctuates so much, is it really there's a fundamental value? And I'm not saying cryptocurrency is crap. I'm not saying that. Maybe we are too early to think about like where should it settle or what the prospects are for that. Um, what's his name? What's Tesla's guy? Elon Musk. Okay, right? Oh, always in equity research. Please understand. Like I tell my juniors all the time. Hopefully, none of the company people are here. Companies always lie. They lie either through omission or through like deflecting you in a different directions, but they always lie. Elon Musk is a great guy. Like I'm not like 0.0000001% of him, right? But please understand, he knows everything about EVs. He doesn't know shit about. I'm sorry. He doesn't know anything about cryptocurrency or stock market or anything. Just because he's amazing and he's great at EVs doesn't mean he's great at everything, right? So, oh, cryptocurrency has gone to 50,000, and Now he's saying I bought 1.5 billion of cryptocurrency and I will accept payments. Well, always think about what's the motive behind what he's saying. He already has bought 1.5 billion. So what would he want? He would want cryptocurrency to go up. So his value or his wealth will go up. That's a different thing. But cryptocurrency, maybe we are too early. I'm not gonna say it's a fad, but it's too early, at least for me to say. Like I'm not gonna buy. It's the simplest answer. I need to understand what it is. I need to understand like how I can value that.
Abhishek, thank you for your question. Is there anyone else from classroom number 19? Okay, so I see there's no one else from classroom number 19, but there's a hand raise from Digonto. Digonto, you can unmute yourself and ask the question.
Hello, Mr. Vaishnav.
Hey,
I'm Digonto. I am the technical trader. So I'm asking you a question. Please pardon me for that. Are
no,
the
you
US
should.
markets heading towards a recession? Are the US markets heading towards a recession?
Oh, if you put a gun to my head, I would say yes. So let's say the way and I'll give you like live example, right? Right. So let's say S&P. Okay, S&P 500 is at 3,932 932, right? As I said, like I manage a little bit of my money, and then I give my money to other people to manage, right? When S&P reached 3,000, I cashed out of all equity position because I think that's too much. It went to 3,300, then it went back to whatever, 25, 2,700, and it's now at 3,900. So I have been wrong. Do I think they are heading to recession? I do. Well, I don't want to say recession because like we are already in recession, right? Like, well, there are whatever. I want to say I forget the exact number of unemployment numbers, but like there are lots of people who are unemployed. Right now, government is just printing money, and you will understand like politics and everything. It's not always fundamental analysis, also policy and everything. But think about money is free. Like I think like home loan. Let's just think about home loan. Home loan in India, I think like the rate is like 10% to 12%. Right now in the US, the home loan rate is like around 2.5%. Usually it's used to be 3.5 and above. Money is free. So then if you think about all the DCFs and all everything I spoke about, what does it mean? All right, if I think about my WACC, working weighted average cost of capital, my cost of debt has gone down so much. I can actually use much lower WACC, which means I can inflate my values, or what it means is my stock prices could go much higher because my cost of capital is lower. So that's why the stock prices are high. So I would say it's more of a bubble as opposed to just going into recession. Like recession could mean like, oh, like there will be more unemployment and everything. Like, and unemployment is already huge in US and across the world, but everybody's just printing money. So I would agree that this bubble. I don't want to go as far as saying recession, but again, that's not my areas of expertise. I know oil and gas, and I'm trying to learn EVs or hydrogen or batteries. That's a job more for economists. They will have much more figures. Like I don't have numbers in front of me to tell, like to have so much confidence. I can talk to you with like some stocks about some numbers because I have numbers. I believe in numbers. I don't have those numbers, but that is my thinking. Maybe an educated guess, but I'm not gonna like I'm not an economist to say it's recession or not. I do think it's like overblown. Like this, there are people who don't have money, people who have like unemployed. There are restaurants and everything that is closing down, shops closing down, and the stock market just keeps going up.
And sir, what will be a good investment strategy in terms of recession? I mean, if is averaging a good option?
Sorry, I didn't get, like, what is the good option? I didn't hear you that.
Is averaging of
Oh,
stocks a
yeah.
good option in terms of?
Yes, in a longer term, it's always like good to have the average cost, just because I wish I could say, oh, I can time the market like, oh, this is the trough or this is the peak. So in from that perspective, it's like overall, I would say yes, but I would be mad to say like, oh, I think like S&P is at 4,000 and I would still be, would I be still dollar of average costing if I think the index are going to drop? Probably not. So it depends on, again, the conviction level. In general, yes, is good, but it also depends on, like, well, sometimes you have to divert from your general rule, just because if I think like S&P, I'm not saying that, but if I think like S&P is going to go down 10-15%, like, why in the world would I do dollar or average cost today? Like, there are better ways to hedge, right? Like, oh, if I think the S&P equities are going down, the debt market could be going up, silver could be going up, metals could be going up. There are other ways to play or hedge it, as opposed to just average dollar costing.
Sir, so would you like to share something else with us?
Yes, I know I have bored you guys to death on this morning, so I do apologize, but I do want to share few things. One is like, as I think I was talking with, like, try to find the job that you will love. It's very easy for me to say that, I know that, but try to find the job that you love, because you're gonna work for it, or work for next 30 years. Uh, I love my job. I absolutely love my job. I have to make sure that I actually spend time with my kids and my family. So I kind of have to balance it. But like many of my friends, like, oh, if it's 9 to 5 job, at 5:01 they're out of the office. No amount of money can make you do the job. Like, if somebody pays you $1 million and asks you to do equity research, if you don't like the job, you cannot work so long hours. So just make sure that you love what you do. And they were like, couple of, I'm not a very well-read person, but if I can say, like, if anybody wants to read a couple of books, I would say read Fountainhead or Atlas Shrugged. Take your pick. I like Fountainhead, but I like Atlas Shrugged as much. And that's just like to grow above mediocrity. And the only other book I will say is like, read Who Moved My Cheese. That's very important as you enter corporate world, because your goalpost keeps changing so much and you get frustrated so much. So it just, that book kind of puts everything in perspective. Like, oh, this is supposed to happen. This is like, oh, not like, why the heck this happened? Like, oh, yeah, it's supposed to happen because the goalpost keeps moving. Always respect women. They are much better than men. Let's be very honest. You will learn this over a period of time, but always respect women. They are much better than men. Have self-confidence, not arrogance, but have self-confidence. Like, I was like, as I said, like, did not get a job out of IMDR. I interviewed, I don't know, 15 times, 20 times. I was the worst person at any interviews. I think like I got my job because one of IMDR seniors just gave me a job without interview. And then when I came to US, it was the same, but I interviewed like over 100 times, and then it became a habit. So like, work hard and have that self-confidence, and you will do so much well. And last thing I would say is there's no shortcut to to success without hard work. Like yes, there'll be guys like Facebook and all that who would be. I still I'm not gonna say he's a lucky person. He has worked hard. There's a book. There's a book called Outliers, where there is a rule, something called 10,000 hours, and it gives so many examples all the way from Mozart to Bill Gates to Sun Microsystems to even Elon Musk and everybody. And the basic rule came down to this, that if you, well, he did Pete Sampras and like everything in sports as well, Roger Federer and everybody. Like it comes down to this, that if you work, basically he calls it rule of 10,000, that if you have worked on something for 10,000 hours, you become an expert. And that 10,000 yes, roughly, if you just think about how many hours a day you can spend on something, 365 days a year, it takes like 7 or 8 years to work on something to become an expert. So if you do that, if you work hard, you will be good at everything. Like don't think about, oh, if I become equity research analyst, I will make money. Or if I become this or that, I will make money. If you are good and have put enough hard work, you will be successful. We can define success however, but if the success is defined as earning more money, because at your age, that's what I always dreamt of, then you will get. But self-confidence and hard work will get you everything. I'm sorry for giving you all that gyan. I know how boring it is, but I did want to share. As I said, I love IMDR. I own everything to IMDR, so I did want to at least pass on those few things. But that's all for me.
So, first of all, I'm here. I'm Dimanto Chakraborty to give the vote of thanks today. So, it's my immense pleasure for presenting the vote of thanks. On behalf of the Deccan Education Society, I would like to convey our sincere gratitude to Mr. Vaibhav Vaishnav for giving us time and inspiring us on the concepts of equity research. So your thoughts and experiences have really inspired us. As you mentioned in your talk about discounted cash flow, procedures, sell sides and buy sides in a trade, and the combinations of fundamentals and technicals for fund management, functioning of hedge funds and mutual funds, along with diversification of portfolio. You mentioned about the choice of careers in terms of doing equity research, whether to choose MBA or CFA. You also talked about loving your job for successful career and taking no shortcut in life. So this piece of information inevitably becomes really valuable for our future endeavor and further corporate career. I would also like to thank our director ma'am, faculty, non-teaching staff for continuously encouraging and supporting us for such corporate. I thank the entire student organizing committee, the technical support, and last but not the least, all my student colleagues without whom this session wouldn't have been successful. Thank you so much, sir.
Thank you. It's my pleasure.